You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the CBOE over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again for the Advisor's Option, the program here on the Options Insider Radio Network. For you out there, the busy financial advisor, an asset manager, you're pretty busy these days. We get it. These markets kind of crazy. So you don't have time to pay attention to the world of options and derivatives. Don't worry. We do it for you. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever exciting, ever engaging, at least we tend to think so, Options Insider Radio Network. Thanking all of you for making 2022 just such an insane year for the network and indeed for the show. Been a great kickoff to 2023. If you do like what you hear, obviously we've been doing this for a long time, 16 plus years now, which is crazy to say out loud. But if you do like what you hear, new reviews do help new people discover the content. So if you like what you hear, go ahead and rate it and review it on your platform of choice. It's available on just about every platform that handles audio under the sun these days. And of course, if you want more in your lives, you have more questions about how to utilize these options products, well, then our Pro Q&A series is for you. You can find that over there, theoptionsinsider.com/pro, as well as our great Options Oddities show, as well as live access to this, everything else we do here on the network throughout the week. Great giveaways. February coming to a close. We'll be giving away the Pro Trading Crate pretty soon for February, and a whole bunch more over there. theoptionsinsider.com/pro is the place to go to learn more. And let's keep on rolling, see who's joining me on the old Advisor's Option program today. First, I am pleased to be joined once again by my co-host, my compatriot in all things Advisor's Option crime, Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. The Oracle of New Hampshire himself. Mr. Matt, welcome back to the Advisors Option Program, sir.
Mark, it's great to be here. Lots going on, and we have great guests, new blue blood in the volatility space. So we have royalty here, so I'm looking forward to it.
Always good to have new blood on the show because we are joined today by a newcomer, a first-timer here on the show, and indeed the network. He is Ken KWALIK, the managing partner over there at CARRICK Lane. Ken, welcome to the Advisors Option Program.
Guys, thank you so much. Honored to be here. Been a big fan. Love what you guys do, and just really happy to be on. Looking forward to our discussion today.
Well, your firm has been on before. We had Peter Montgomery from your firm on this show back, in the crazy days of October of 2021, Ken. But this is your first appearance on the show. So let's start off, as we are wont to do with all of our first timers here on the network. Give our audience a bit of an overview of your background in the options and indeed advisory space, as well as what it is you do day to day over there at CARRICK Lane.
Yeah, you got it. Definitely. So I've been, in the space really since I started my professional career, call it since 2000. So, dating myself now, but well over 20 years. Started as a market maker, as I know many of us did, on the floor of the CBOE. So, learn the machinations of kind of, how these products work from a risk management perspective and a trading perspective. Was with SLK Hull, which had been acquired by Goldman Sachs at the time. And so I was a market maker there in a variety of equities, but mostly index products such as the SPX and the NASDAQ and the burgeoning QQQ at the time, which feels like such an old product now, but was actually a new thing back then. So yet another mark of my age here. But yeah, so I started my career there and then transitioned to the buy side. I'm around 5 or 6 years after that. Basically moving to New York and working with a group at Credit Suisse that really was called Volaris, which was really one of the first forays, into option strategies, basically rolling out option strategies to advisors on a fee-based managed account basis, right? As opposed to kind of before that, it was mostly a transactional product, maybe a costless call or something like that, as opposed, when it came to users in the private banks and the like. And so I was there for a couple of years, went over to Goldman Sachs, where I spent back to Goldman Sachs, I should say, into Goldman's PWM division. This time, creating kind of a whole new desk there that was a little bit similar to what we were doing at Credit Suisse, that focused on not just call writing and kind of costless collars and things of that nature, but in particular cash secured and fixed income secured put writing, specifically on major market indices, which it's grew into a very big business kind of over the years, and was there for some time. More recently, I worked at Harvest Volatility Management for a stretch, basically building kind of a 2.0 version of that, I like to call it, for basically, the burgeoning independent movement that we've seen with so many advisors in so many different ways. Having had some common background with the folks there back from the Volaris days, and then more recently, we about a year and a half ago, we completed a successful and friendly spin out of that business, taking the key team members and key portfolio managers and our track record and so forth with us to form the group called CARRICK Lane. Which specifically focuses really on just the simple, the kind of very simple, but we like to think, active and thoughtful, if nothing else, implementation of call writing and put writing. And so we work with, a bunch of different advisors, from the independent who's, kind of working on their own and maybe, custodies at one of the big shops, or, to the roll-ups, to a few platforms here and there, and working with some others. And so we're just, very excited to report we just have crossed $1 billion in AUM. So we're very excited about that. And yeah, it's as good a time as ever for these strategies to, I think, to continue to be in use, and happy to be talking about it here today with you guys.
Billion AUM, congratulations. That's no mean feat. I know how challenging it is to get there. It seems like once you crest that wave there, Ken, things start to fall in line. People think, okay, you guys are reliable. We can allocate some funds to you once you get to that 1 billion level. I know I've talked to advisors in the past. Once they start getting to that level, all of a sudden the phone starts ringing and the fund starts coming in. So it's a long slog. I get it. So I tip my cap to you, sir, as it's time for us to keep on rolling right on into the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement, the segment of the show that was born of the pandemic because we spend so much time at the top of every show talking about what the hell just happened in the market since our last show, because inevitably something crazy and unprecedented and just kind of wild happened in between episodes. So we spent a lot of time talking about that, which ended up becoming its own segment. Mr. Matt, it's been a while since we checked in with you, so we'll start with you. It's been, I think, since early in the year. So we are, of course, not so much, a little bit today, but we've kind of backed off of it now. But we were really in the teeth of just this really strong rally. The market was just getting the bit in its teeth and running. The Fed kind of undercutting some of that. Now we are back down, listeners, vacillating around the 4,000 level, a little bit below it in the SPX as we are recording this, obviously having retreated a few hundred handles off the highs from right about when we went into that Fed announcement. Obviously, vol still frothy, but coming off a little bit off the highs out there as well. So a lot to unpack. We'll start there, Matt. Are you as surprised as everyone else has been? I know talking to you a lot last year, you were, like a lot of people, thinking this first couple of months of the year was going to be just a rocky start to the year. And instead, it was BTFD all day, Matt.
Yeah, my call has been eventually the markets are going to catch on. And the don't fight the Fed on the way up is going to be the don't fight the Fed on the way down. And they'll start to understand that. I thought earnings that we just are going through and almost done with, it was going to provide some guidance, but not, I think, when I was making the call late last year, when the Fed starts raising rates, it's going to hurt the earnings. I thought it was going to go from 234 down to about 200 by next earnings season, that ends in April, May. It's on its way down. It's 219 approximately for the S&P. Still very highly priced market, 18 plus PE, which makes a equity. If you take the inverse of that, it's about 5-point-something%, which is, you could get a 2-year treasury for that right now. So it's pretty highly valued market. But people are there's still cash out there. People are still have the rose-colored glasses on. They're still buying. We knew it was going to be tough. The protection that I was talking about were these calendars, where out of the money put calendars that could, that aren't going to cost you a ton, but that will participate on the way down. I thought volatility was going to be pretty muted, even though I think we're in a bear market. And those things are coming to pass. Even though we had a big rally, I think now people are starting to understand it. It's looking a lot heavier than it was early in the year. Clearly, now it's not just the rally. You get to see the pounding coming in. Of course, the zero DTE stuff has been interesting to watch. I'm actually doing a fefew trades, and we have quite a few clients that participate. I think that some people were saying that could be kind of a Vol-Mageddon 2.0, but I don't think so. I actually think it kind of mutes some of the volatility.
Oh, interesting. You should vote in our poll that is live right now, Matt. We are asking that exact question right now. That is our question of the week.
Ah, I did not know that. Well, now you know where I and so, I think it's just, vol is actually, a little bit high compared to historical. I don't think vol is going to spike too much. There's so many people positioned for a bear market that, we're somewhat elevated, but, as the market goes down, some people like me are kind of covering some of their puts. So, I think it's going to be an interesting market this year. I think it's going to be much different than we've had in prior years. So this is going to be a good place to come and talk to people like you and Ken, and see what's going on, Mark.
Well, let's do that. Let's talk to Ken about that as well. Ken, I want to get your thoughts on what's happening right now in a second. But since this is your first time on the network, and indeed also your first time, obviously, for the mad new year that we are in right now. 2 months almost in the can. Let's start there. I've been kind of taking a poll of a lot of our new guests here on the network this year in terms of what really stands out, what resonates to them in the mad year that was 2022. I know you have a whole white paper about this. We're going to get more into detail about this in a little bit in the Buzz segment with all of your findings from multiple years. But for you, Ken, when someone asks you, you're at a dinner party and someone says, hey, what did 2022 in the market? What really resonates to you, Ken? What are the things that stand out?
Well, I think one of the big things, and this is, I guess, an unabashed kind of, endorsement of our space is that, when you think about a lot of the traditional allocations that, let's say, most call it ultra high net worth or high net worth investors have. It's not like liquid alts is anything super brand new, but obviously a lot of these have some directional component alongside a volatility component. And last year, so there's always kind of a story alongside a big market move, but and usually a lower correlation in many cases to what bonds are doing. But last year, everything was kind of down, right? I mean, equities are down and bonds were down. And so there was an actually excellent article, I think it was on Bloomberg, sort of right to close out the year, that talked about how several funds on both sides of the vol trade, so short vol folks, namely in equities, and longer vol players, namely in bonds, had both done well. Right. And that, and that's in addition to kind of the growth of the space overall, which, like you said, we'll talk a little bit later about in this segment. But so I think that people are realizing that it's kind of funny. Sometimes you have all the long vol guys on one side, all the short vol guys on other sides. It's been our mantra here at Carrick Lane and in past jobs I've been in that there's a place for almost both products in your portfolio, as counterintuitive as that may seem. And if you can apply these things strategically the right way, you get a year like last year where, it wasn't a straight down, fall like 2020. And you see, folks, I think efficiently and using these zero DTE options, obviously to, some success. Otherwise the volumes wouldn't, be continually increasing, as well as the managed products. And so we're just getting a lot of questions about, for example, our fund was our strategy was up last year with our collateralized put writing with the markets down. And so a lot of people are kind of, ask the question, wow, I would expect that to be down. And wait a minute, a couple long vol funds did well too. So, I think that was kind of I don't want to say the surprise, but after a few really rocking and rolling years, 2018, obviously, 2019's year, 2020, obviously the rip back, everybody was so focused on these monster moves in the underlyings that sometimes vol products can be an afterthought, right? Whereas in a year like this year, where both your traditional asset mixes were getting hit, the fact that volatility strategies from both sides had a place and some did well to quite well was really interesting for people. And so we get that question a lot. And that's when we like to talk about, obviously not just what we do, but others in the space, And
we talked about the demise of the 60-40 portfolio many times on this show over the years. Last year, one of the worst years in the history for that. You got hit on both sides. So a rough year for your standard advisor who's rocking the 60-40. But Mr. Matt, obviously crazy time. You had a little bit more time to think about it while I'm getting our guest back here. Anything else that really resonates for you from the mad year that was last year, sir?
Well, I mean, I think the biggest thing was, the VIX never got, above, 30 something. I mean, it was a crazy year where, the VIX remained very muted, and a lot of people didn't expect that, especially with the market down as far as it was, So I think that was one of the bigger things. The put call slope became very cheap, which was very odd. Usually, like we measure it every 10 deltas lower, it's usually about 8% higher in volatility. Last year it got as low as 1 or 2%, which was crazy. And we used to talk a lot about that kind of out of the money call that the Reddit crowd loves. Those more or less disappeared out there in the market. So we did. It was quite a different year. We do a lot of back testing, and the back tests that usually did well didn't do well, but we predicted that in some sense. We said, hey, listen, this is going to be a different year. You might want to start looking at 2018 as an analogy, 2007, 2008, 2015. And those years did have some consistency with 2022. So those are a lot of the things that we saw, Mark.
All right, I think we got Mr. Ken back now. Obviously, a crazy start to the year. What are your thoughts on the mad run-up? Now a little bit of a pullback there that we've seen so far here in 2023, Ken.
Yeah, I think the big thing we want to see ultimately is the VRP, like the volatility risk premium, specifically in the SPX, where most of our products are, to remain positive, obviously from a short seller's or from a short vol player's perspective. And I think one of the themes we've seen has been, and some may say this is a mark of a healthy underlying market, is this, lower correlation amongst the S&P constituents. So you see that a little bit in the, in the earnings reports and whatnot, and in a lot of the directional moves. So while we're still, I think, seeing some of the whipsaw effects of, it's been a fairly big directional move in both Jan and Feb. If it's not these 10 or 11% moves, kind of completely macro driven moves, and it's more of a, okay, let's figure out winners and losers kind of story, but still with a net kind of range bound or even, just slightly down kind of market, if not up, that's going to be okay for us. And I think there's a reasonable scenario that the market does that, right? I think with just fixed income vol calming down, currency vols calming down, there's just much less sort of cross currents underneath. And that allows, I think, stock pickers, active managers in general, whether it's, your bond manager or your, equity manager or your vol manager, to, ideally extract some value from that. So we're actually optimistic on, call it active managers 1 and 2, carry trades of various types, including, I think, short vol.
And we're always interested and or intrigued by what's going on in the world of earnings volatility. So let's get to it now. A little bit of the old earnings volatility report.
Earnings announcements can move markets. But what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, Mr. Matt, when you're not talking to me, you and the team over there at ORAT's busy crunching the numbers on all things earnings volatility. Has been another banger of a season, which is kind of surprising. We were expecting such dire numbers out of a lot of these names. I know since we've been running these numbers now, which goes back to even before the pandemic, the long-term average has continued to tick up. It's somewhere around 92%, I believe, right now. And for a little while there, this season was just blowing the doors off. It was up around 150. I didn't think that was sustainable. And sure enough, it's not. It's come down to somewhere around 110%, I believe, of the last time I checked, but still robust, still an outperformance season by just about any metric. I'm curious for you, Matt, you're crunching these numbers all day long. What are some of your takeaways from this surprising earnings season so far?
We have made earnings great again, Mark.
Yes, double-fisted, you and I.
No, we called it. We said, listen, this guidance is going to be super important this earnings season, and it has been. There have been some home runs, and there have been some no hitters, and we're at 12% return on buying a straddle for these firms. So just for everyone's edification, again, ORATS puts together kind of an overview of the earnings season. There are about 6 weeks, important weeks in the earnings season. We're in the January one. Of course, there's April, July, and October. January, I think, is one of the more important ones. And so what happens to week one? The larger firms, if they're accounting together, get their numbers out quick. Usually there's not much return on buying straddles. So we measure the kind of the straddles and the volatility skew to come up with a prediction of what the market thinks that these stocks how much they'll move, and we compare them to the actual move. So usually week one's not that great. Week 2 is getting a little bit better. Week 3 is usually good. Week 4 is better. Week 5 and 6 are kind of average. We had a huge week 3 this year. 143% made the option straddle buyer. So that was that was a big week. That's what we kind of thought. We thought that, a lot of people, there's a lot of people following, a lot of analysts following the bigger firms, but I was particularly concerned with the smaller firm, medium-sized firms that aren't as followed, to see what their outlook was going to be. It hasn't been that good. Like I said, the earnings for the S&P is down pretty precipitously, and I think that's being reflected. I think next season's probably going to be even. I would say about the same. Pretty banger of an earnings season with a lot of movement there. I think that's going to be the one where people are going to find out, that the outlook isn't that good. I think we're going to see, if we aren't in a recession, we're going to be close to a recession. I think the Fed is, people are going to find out that inflation is a lot more here to stay than people thought. I hate to put a damper on everyone, but this is kind of what I think is going to happen here. And I think it's going to be reflected in the earnings. As far as the specific companies, we're kind of late in the season. A lot of retail coming out. Ross Stores after the close today. Dollar Tree, Lowe's, those types of stocks coming out. What I'm seeing too is a lot of the implied versus the past earnings move. The option market makers are kind of catching up, and the valuation is actually getting higher than in relation to the past moves than we've seen before. So, kind of makes sense after this. They're probably licking their wounds right now and saying, I'm not going to get whacked again. So the vol's a little bit higher for a lot of these ones reporting that we're seeing, and that's what I'm seeing out there, Mark. Over.
I think your dog agrees. Your dog's seeing a lot of vol out there on the earnings front as well. Ken, same question for you. I know you're busy looking at a lot of different aspects of the options and indeed volatility market. How big of a driver, if at all, is earnings season and earnings volatility for you guys over there at Carrick Lane?
Yeah, I mean it's definitely something we keep watch on, and like I said in kind of my last answer, it's something that typically we like to see correlation, that leading to a lower correlation in the S&P, and to the extent that can happen, that usually gives you an additional advantage in selling S&P options. So we keep a pretty good eye on it, but I wouldn't say we're not purveyors of of any real kind of single stock selling or options buying strategy. We mostly live in the index world, but it's definitely important to watch as you come in, because I think is a very good point brought up just now, and that trying to capture kind of, or at least have your finger on the pulse of what people are seeing and how the market makers are faring through some of these outsized moves. Usually can have some ripple through effect, especially in some of the big names, right? I mean, Apple and so forth are such big names in the indices that you can't avoid looking at them. They have an effect.
That they do. You know what else has an effect, listeners, on the entire segment? It's the buzz. So let's get to it.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everyone, welcome to The Buzz, the portion of the show where we break down all the latest developments, maybe breaking news, stories, research, all the fun stuff from the world of options and derivatives. And maybe you, as a busy financial advisor, asset manager, didn't have time to check out because you're fielding calls from your clients left, right, and central as this market is whipsawing plus or minus 1-2% intraday, day after day out there. We get it. You're busy. That's why this show exists. And Ken, the reason you're on the show with us today is because you put together a very intriguing white paper over there for our friends over there at the SIBO, all about kind of what we're talking about here on the show today, which is kind of the use case for options for the advisor, for the asset manager. As you put it here, the title of your paper, Investing in Options, Past Growth and 2023 Potential. So it's your paper. I'll let you run with it. Give us a bit of an overview for our audience, why you decided to delve into this topic now and some of the interesting findings and takeaways you guys discovered.
So I think really what we're trying to do here is highlight the fact that there's a very much a use for all strategies in this space. And even though over, call it the last 20 years of the sort of professionally managed options strategy space, you've had a couple, I don't want to say blow-ups, but, there's been some negative experiences here and there along the way, usually having to do with leverage and things like that. But the fact of the matter is that the space comes back stronger every time, whether it's, a volatility product itself or just the market or whatever. I think that's really a testament to everybody involved in the value chain. It's you guys. It's the CBOE, hosting things like this. It's the conference circuit. It's all of that stuff that filters through to the advisors. Because at the end of the day, this is a product that takes some education. It takes some getting to know it. I like to call it a lap around the P&L track, before you really can, I think, understand how these things work, when they do, when they don't, and when to use them, right? And I just think that, what we're trying to basically show here is not just the growth of options over time, SIBO and so many do a great job of that, but also to really show kind of, how this can, how did these different strategies to I guess, partially my answers before, how these strategies can work in higher vol regimes, right? Because most of the QE era, right, really since 2009 was, it's been a one-way market, with a few blips here and there, 2011, 2015, but, pretty much a one-way market. And then, people complaining about low vol and so forth. But, then all of a sudden 2018 comes and, you have the Volmageddon event and then the end of the year and then a sharp drop in 2020 and then a slower drop in last year in 22. And so I think it's a really interesting time to go back over that period and say, okay, how did various managers, how did various strategies, how did various pairings, if you're doing this as an overlay, how did that work, right? How did it work? How did it look? What were the use cases? And, ultimately, is there something there that, from an advisor's perspective, fits my portfolio?
And you zeroed in on two strategies that are very popular with our audience here, the cash secured puts and the covered call. Why focus on those two, and what were some of your findings for those two in particular?
Tried and true products, really. I mean, it's what most people know, and I think we're super excited to see other, sort of responsible and good players. I know there's been a lot of, stock replacement trades, programs. There's been some really interesting vol arb programs, some long vol products, like I said, especially on the income side that did well last year. But we like to stick to kind of the really simple stuff. And so I think with covered calls, 2022 is a reminder that, markets don't go up forever, right? And using, covered calls to sort of enhance or, an exit program to, force sort of some discipline, if nothing else, into a selling program is not a bad idea, especially when you have a market where, levels are still pretty high, but volatility isn't achingly low either, right? That's not usually the case in prior markets, right? So we've seen, quite a bit of interest in folks doing things like buy rights, for example, or like I said, just a graduated sell program. On the other side, the put writing side, that's where we have the bulk of our AUM and the bulk of our clients. And what I think, it gets back to one of my answers from before, which may or may not have been truncated. So again, apologies there. But really, it's kind of interesting that, the market was down 20% and some of the short vol funds were up, and including ours. And so we're very proud of that. It wasn't up by a ton, but the fact that this market is basically giving you some opportunities, to I think show your call it your skill, your active management style, whatever it may be, which we view personally is the right way to look at things in this space. There's just too many opportunities given now options decay, especially in the short run. So we're still seeing a lot of interest in that put writing side because people can look at things now and you might say, okay, well, I might not really need yield necessarily, but you might not be too excited about equity markets either. So a lot of advisors are looking at this and saying, well, if I can pair, via an overlay, a fixed income allocation with some conservative out of the money index put writing, I can sort of combine two risk premiums, right? I can combine the volatility risk premium via selling options and an equity risk premium by selling puts, right? Even out of the money, whether they're capped via put spread or whatever it is. And so I think that's where we're seeing a lot of people say, well, that might make sense in a market where I don't think we're going to see these QE era type years where, you're up 30% on a 10 vol, right? A 3 sharp. It's like, it doesn't happen that often, right? In equities. So I think that's one of the interesting things, kind of going forward this year, even though rates are obviously higher and one might think that yieldy products, potentially could suffer.
Ken, could I ask you a question? You mentioned the VRP, volatility risk premium. It's very interesting. Of course, ORAT says a lot of back testing. We could back test in certain environments. Could you, just for our listeners here, explain that a little bit more, how you calculate it, and then how you use it in your strategies, if you don't mind?
Yeah, absolutely. So with the volatility risk premium is basically calculated as the difference between what the options markets imply that in terms of the market's volatility, usually measured on a daily basis, so close to close, minus what it actually does realize, right? And historically, that's been a positive spread. In other words, put simply, options, specifically in the index world, in the broad-based index world, tend to be more expensive than what they theoretically, or I guess in practice, should be worth. And so, why does that exist, right? It exists simply because most options users, specifically post-global financial crisis, are net buyers of options, right? It's the insurance analogy that you may have heard. Some of the listeners here may have heard about if they've ever seen these products, which at this stage, a lot of us have been out there for some amount of time, so it's not totally new, but still kind of nichey. And what's important about the VRP is it's a differentiated driver of returns when you think about combining it with a classic, kind of 60-40 portfolio, right? It's not necessarily correlated, at least not in a strongly positive way to sort of either of those asset classes. And it essentially gives an option seller, an additional edge, if you will, in terms of being short that option. Now, there's differing risk, metrics once you have that in place that you have to manage. You use a fixed strike instrument, for example, even though it may be below market and it might be capped in a spread or something like that. You've got, risks that you have to manage. And so, one of the things we do at CARRICK Lane is we provide a diversified portfolio, right? A staggered and laddered, as we like to call it, portfolio, multiple strikes, multiple expirations where we have our risk on. And we try to be smart about, how we manage that through time, right? It's not just one kind of set it and forget it thing. It's managing the trade and the positions throughout their life cycle, thinking about how the positions affect each other, thinking about known unknowns. So to Mark's, very good questions at the beginning, what do we think of earnings? What do we think of this, that, the other? We look at all those things. We try to determine whether, in our view, not so much an extreme directional view either way, but, are the options markets basically implying a volatility or a movement in the market that's too low, or that's, commensurate or maybe even higher that with the long-term sort of positive volatility spread, right? With, again, in the example, typically being the insurance analogy of people being willing to pay more, for an insurance policy, even if it doesn't pay off, right? Usually in terms of downside puts. And so we look at those things when we manage our portfolios and as we roll out positions and we manage, positions through time. And it's an important component, of what we do. But there's many risk factors that go into it, and we just try to stay, eyes wide open. Because at the end of the day, in a lot of our products, and again, there's various products throughout the spectrum, which maybe could be the basis for another call, but we're just trying to add some incremental yield to investors' portfolios without necessarily, tracking Delta One equities or anything like that, right? It's a very conservative strategy. So when that you're dealing with options that are typically expensive anyways, you want to just, and usually when markets are selling off, right, that's when let's get even richer, right? You want to have some sort of dry powder. You want to have, kind of a plan to, if you have to roll your puts kind of down and out, to be able to be in a position to take advantage of that, while still managing risk. So volatility risk premium, it's just another way of saying index options tend to be expensive, and it helps your short seller.
Thank you very much.
Definitely a bias towards harvesting a little bit of the old risk premium. We talk about that a lot on our Volatility Views show as well, listeners. If you're intrigued by these concepts, things like the volatility risk premium, you want to dive deeply into those, check out the Volatility Views program, which all of you should be doing. If you're listening to this show, you should be subscribed to the full network already. And you make some interesting points here, Ken, because of course you chart this data over time, the volatility risk premium. Some people might have been a little bit hesitant last year, a year where we're selling off aggressively to do things like cash secured puts. But you found with your data here, even during the max drawdown of over 25% in the SPX, you were still positive, harvesting that net volatility risk premium over the course of the year. So that may come as a surprise to some of our listeners there, Ken, but you have the data to back it up here.
That's right. We have a GIPS verified track record, which is another thing that I bring up in the paper. And thanks for mentioning that. I think, when we think about volatility risk premium, it just goes to show you how powerful that can be in a year like last year, where it wasn't necessarily easy. But again, that volatility tends to lift as equity markets sell off. And so if you can kind of play defense, sort of a doctor's credo of do no harm first, and sort of manage positions down, manage through, ultimately I think what it was, like 7 of the CPIs where the market wound up moving much more than options would have implied. So there were some times where that volatility risk premium was negative and didn't benefit the option seller. But, the way we kind of look at things, and again, there's multiple approaches in this space, but we sort of want them all to do well. But the way we look at things is, we'll try to actively manage kind of around those things, take risk off into those events, knowing that, there'll still be plenty of premium to harvest post-event. And so event analysis and what they call event vol, not to geek out too much on it, but those are all things that we look at. And yeah, I think, one of the additional points of the blog post of the paper is, now there's actually a Morningstar category for option strategies, which I think now is, when it was put into place, it was 10 billion. Now it's like 56 billion or something like that. So, there's real information if, some of the listeners or some of the advisors out there, would choose to work with a managed program or, a professional provider. There's real information on these managers' track records, right? And done in a professional way, in a vetted way. And I think that's just gives the space more credibility, right? And just helps in the educational process, which we're really big on.
Don't get me started on the Morningstar ratings there, Ken. I like the fact that they've added options, the fact that they lump everything under the options umbrella, a little bit of a problem. I've mentioned that to them before. I would like to see a little bit more depth in the options category, but the fact that it exists, you're right. It is a good starting point. So they need to move beyond it, but they've been hanging out at that starting point for a while. But it's a good starting point nonetheless. Ken, here you also point out your outlook first off for 2023. So if you want to share that with our listeners, have at it. And then also some potential tailwinds or obstacles for folks who are considering these strategies may want to consider as well. So lay those out for our listeners as well, Ken.
Yeah, absolutely. I mean, I think, look, we ultimately think this is going to be a good year for, many types of different carry strategies. And I think that, sort of a conservative put writing program, applied with some care. I mean, we always tell people to think about the sizing of things. And we always tell people, something taught to me back on the floor was when in doubt, tranche it out, right? And take your time. And so I think there's plenty of tail risks, probably, more so to the downside, but I think more of them have been priced in, and obviously we're starting from a lower level than we were at this time last year. So I think that it's going to be one of those years where we'll ultimately get to where we want to go, but it's going to be both hands on the wheel, right? I don't think it's going to be quite as volatile as last year, but it's not going to be smooth sailing either. So ultimately I could see a VIX sort of, instead of, hanging out in kind of mid 20s all year, I could see being in the high teens, sort of low 20s with a market that, really, I think we're not really going to get it perhaps sounds trivial, but we get our, kind of final marks here until the end of the year. I think that's when you're going to really see some of the earnings, either weakness or labor market weakness, and ultimately getting into the next political cycle. I think that's where, the rubber's really going to meet the road. I think this quarter and next, I could see a lot of treading water, and in 4,000 has been kind of this mark we've been, vacillating around. I could see that continuing. And then, Q2, Q3, Q4, especially being really, really critical. And so I think we're net positive slightly. The market still remains pretty strong, and PMIs haven't, slipped to all-time lows. So, I think, but it's a unique market. I mean, after everything we've been through with COVID, I think there's, again, the risks are probably to the downside. But I'm not sure that it happens in a quick way. And so in terms of risks and things to your second question, I think, the biggest thing is the self-understanding of it. And I think that's where things like when you're using a manager, right, where things like what I was just talking about, track records and whatnot, and analyzing drawdown situations, making sure that you understand how that works, especially if you're using it in any sort of an overlay format, which is a very common application of these, especially at a lot of the big private banks. And so I think it's one of those things where you want to look at those months, you want to look at it, compared to what, your collateral did that might be supporting that, or, and just really just look at that and say, okay, what kind of market did that occur in? And do I feel comfortable with that? Like, can I sustain that? Because especially with put writing on volatility selling strategies, you don't want to be stopped out kind of at the bottom, right? That's when you should actually be adding to it. So that's why one of the biggest things that we always harp on with people, when we're talking to risk committees or things like that, even is almost regardless of the manager, always think about your sizing. And so what we would say is, look, if you have a view that we're going to have a very sharp sell-off, in other words, I like to call it catastrophic sell-off. So, something 30, 35% or more in nature, like we saw in 2020, as opposed to sort of a valuation-based sell-off, which you normally see every 2 years or so, 15, 20%, right? If you see a catastrophic sell-off coming, quite frankly, collateralized puts, might not be for you, right? And that's okay. We don't recommend it to everybody. And, getting into a long ball strategy, where we would point you to some of our other good friends in the industry. And, but if you view something as, if you view this as a kind of somewhat range bound market, or even a slightly down market, but not one that you see going materially lower, then I think it just becomes a sizing question. And, you just have to be very, very aware. And if it turns out, you have those moments, just, be aware of how the strategy performs, what it looks and feels like in that moment. Nobody really knows until you have real money in it, right? Of course. But that's why we always tell people, start slow, see how it reacts, see how all the positions work together and go from there. So it's just eyes wide open on what your own personal underlying economic outlook is. And then marrying it up with the size, and then there should be, kind of no surprises, right? So
a lot to unpack there. We have to keep on rolling in the buzz really quickly, Matt. This has kind of been one of our ongoing discussion points, you and I, for a couple of years now, is can this surge of options volume continue post-pandemic? I thought 2020 might have been the high. 2020 proved me wrong. I had my cynicism beaten out of me. So I was a buyer on options volume for 2022, and it was a banger year. Coming into this year, the same question was raised, Matt. Can we possibly continue this options party that we've all been living through here? And we're recording at a weird time because it is literally the last day of February, so we don't have the exact numbers for February. We'll have them in our hot little hands tomorrow, so we'll know exactly what the answer is for February tomorrow. But we do have the numbers for January right now, and January was another banger, Mr. Matt. 923 million contracts on the tape. That was up nearly 3% from January of 2022, and also the third highest month in the history of the business, Matt. So I guess so far, to kick off the year, the old adage that options like a bull market is apparently true, Matt. Are you surprised by how much volume we're seeing?
I always try not to get too positive because my business is so related to more trading. So I just try to, I'm always lukewarm. I can't believe that they can continue at this pace. I thought the Fed's liquidity drying up out there. They're not letting their balance sheet go as much as they did before. I thought that might hurt it, but a bull market helps, and also with a lot of volatility and a lot of uncertainty, and then I think the technology and more education, people are coming at us from all directions now. So a lot more interest in options. I talk to institutional clients. I talk to retail, and everyone's talking about options. So it's continuing to go, Mark. Let's just ride it as long as it goes, I guess.
Ride the bucking bronco until it dies of exhaustion beneath you. Well, let's see. Speaking of asking and inquiring and interested in options, we got some listeners who want to do just that. So let's get to them with the time we have remaining, a little bit of the old office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to our office hours where you folks take the reins, your questions, your comments, our answers here. And Matt, we alluded to it at the top of the show. You've already kind of given your vote. I want to get both of your thoughts on our question of the week right now. Then I'll get to some of our live folks. I see the questions coming in there as well. But our question of the week right now, very relevant to what we're talking about here, listeners, is very simple. Is the zero DTE explosion in SPX, is it increasing intraday volatility? Yes or no? Matt, you've already given your answer. You're on the no tip. A, why do you think that? And B, which way do you think our audience is going?
I think that because I think a lot of at least the strategies that I'm seeing are selling way out of the money to collect premium early in the day, and there are more sellers, it looks like, of premium. So like the SPX now, a lot more people are playing because A, you're not taking overnight risk. B, the options are a lot lower with 0 days to go. And so people could put in their strategies. They're doing a lot of analysis, and so I think that most of them are selling. And so if they're selling to market makers, that's going to usually mute the volatility. The speculators aren't really hedging, but the market makers are. So as the market makers get more and more options on their side, they don't have to hedge as much. And I think that they're using the zero DTE in their favor if they are kind of natural sellers of out of the money puts. But I think with the zero DTEs and maybe the 1 day to expiration, they're able to watch their risk a lot better, and especially with what is it, 20% of option volume there. So market makers are very savvy, and so I don't think it's going to cause like a debacle like we saw at Volmageddon, where these option products really where the people kind of front ran them and put the backers of them in a bad situation. That's what really caused Volmageddon, but I don't think that's going to happen here. So I would say it's more of a reduction just based on those things, Mark.
You think our audience is going the same way?
I don't know. I've been interviewed a couple times this week, or I guess last week, by magazines and stuff, and they're frothing. They're going, "Oh, this is going to be the worst thing ever. It's going to, So I don't know. I think you have a smarter crew, smarter agreeing with me. I know that's pretty bad, but I'm going to say, they'll agree with me. Less volatility.
Interesting. So you're not a subscriber to my Gamma Bomb hypothesis, which the T-shirt is forthcoming.
No.
Mr. Ken, same question for you. Which side of the debate do you fall on? And then B, which way do you think our audience is going?
Yeah, good question. I love this question because we get it a lot too. And I would say this. I generally tend to fall on what Matt's saying. I think that generally speaking, right, because people are smarter about risk these days and so forth. With that said, I think on days when you have a really outsized move, specifically some of the CPI numbers last year, I do think there were some people forced to kind of cover, and there were maybe some pros in there or whatever who were using it as a risk mitigant tool. And, you saw some really jumpy moves into the close after an already big day. So I'd say this, it still winds up, I think, muting vol with a couple notable exceptions. And so that's the answer to the first part of it. And the second is, I'm going to guess the audience says that it expands vol, but that's just from what I see in the FinTwit world.
The audience is taking the other side of both of you. 65.1% right now saying yes. 34.9% saying no. Listeners, that's available right now at Options. If you're listening after the fact on the podcast version, that'll be live throughout the rest of the week. So if you're listening down the road, you'll be out of luck, but you should be following us over there at Options anyway. We have a lot of great questions of the week that come out every week to test your noggin on all these types of fun topics. Speaking of testing things in the world of zero DTE, we have a live question here for you, Matt, coming in from Nichols. Nichols wants to know, can you even back test the zero DTE trades, or is the time frame so short that the data is meaningless? Matt, you're pretty much the king of the back testing. I'm sure you're getting a lot of queries about this exact thing right now. People coming to you saying, hey, can you back test this zero DTE strategy? What are your thoughts on back testing this zero DTE stuff, or is it not worth the time?
No, there's a lot here, and you just have to compress the time. So what we've done is we've put together a very intricate 1-minute database where we can combine all of the information on individual options, and of course having good implied volatilities and open interest numbers and volume numbers, et cetera. And then combining that with summarized data, like, what is the 10-day implied volatility constant maturity? What is the 5 delta of 10-day? And looking at using those as signals. And so we're building a large database. We don't have the back tester done yet, but we do have the ability to back test the last 15 minutes, from one day to the next. So we've been doing quite a few of those for clients. But what we're finding is, a lot of these, people think that it's just gambling, right? And so, but a lot of these zero DTE guys have some very sophisticated algorithms that they're using, and they're using, we could calculate volatilities across the market. How, for example, what's the weighted components implied volatility versus the S&P volatility. They're using a lot of these things to trigger trades. They're using the direction of volatility. They're using like MACDs and RSIs on implied volatilities to trade. So it's there's a lot going on out there, and so you can backtest it. When we have it, you'll be the first to find out. We're getting some interesting preliminary results. In our dashboard product, we have a signal builder that you can put these ratios in and watch them, and it's incredible to watch the volatility of the day go right with the market. So there's a lot to back testing this, Mark.
Great question there, Nichols. Unfortunately, that music means we have come to the end of this episode of the Advisor's Option. But before we go, Ken, we mentioned all the great research you put together for that white paper. Where should folks go if they want to check out that white paper for themselves, Ken?
Absolutely. They can go. It's actually still on the front page of cboe.com. There's a great link right there. It's under their Volatility and Insights blog. So I would start there. That is where they have hosted it and have been great partners, as have you guys.
And if they want to learn more about all the stuff you guys are up to over there at Carrick Lane, where should they go? What should they do, Ken?
Absolutely. www.carricklane.com, CARRICKLANE.com.
And Mr. Matz, if they want to ask questions like Nichols just did about back testing zero DTE, or check out all the other cool stuff you guys have cooking over there in the land of ORATs, where should they go? What should they do?
Yeah, I'm at Matt at ORATs, so you can always reach out to me directly. We have a great new dashboard product. We just released live paper trading, so you could test out your zero DTE strategies there. And like I said, we have these signal builders, just killer stuff. So come on over to orats.com, try out the dashboard product. We have a great inter-day API that we're building that back tester on. Every 1 minute you can go by and find anything. So orats.com or Matt at ORATs, Mark.
There you go. You know where to go to learn more about all things going on in the land of OIC. It's just optionseducation.org. And of course, for all of you out there saying you want a little bit more in your lives, don't worry. If you're one of our pro members, you're listening live right now. We'll be back in a little bit with another great pro Q&A session. We'll be joined by Steve Sosnick from Interactive Brokers, answering all of your many and varied questions. I got a feeling Zero DTE will be represented there as well. You can't escape it these days. Then back again throughout the week with all the rest of our slew of content hitting the airwaves until we're back again with the next episode of The Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.